Hi, I'm Jeff Saylor, and welcome to my step-by-step series. The accounting and reporting standards can be difficult to read and comprehend at times, and many practitioners find that while the information is accurate, the organization of the material makes it difficult to follow. For this reason, I developed this series to address various accounting and reporting topics in a logical step-by-step format in an effort to assist with your understanding. In this installment, we'll look at a very pervasive topic that's also quite complicated: accounting for income taxes. So let's get started. Before we get into the steps, let's look at some basic concepts, beginning with, of course, the scope. Who has to deal with the accounting for income taxes? Well, all entities subject to income taxes. So what taxes are included in the accounting for income taxes? Well, certainly domestic taxes based on income. And this would include federal income tax, state income tax, local, including franchise. A lot of times, some of these places like to give it a different name, and when in fact it's still because you're in business and making money, and even foreign. So that all goes in there. So I don't know why I stuck that in domestic, but there it is, it's in there. Taxes on operations which are consolidated, combined, and under the equity method. Those are also in there. What will it not apply to? A franchise tax based on capital. And of course, those of you working in those states will understand when it's based on that as opposed to income. The key here is taxes on income. Also will not apply to withholding tax for the benefit of a dividend recipient. And you say, well, why not? Well, because that is not the tax of the entity in the first place. That is tax withheld for the benefit of that recipient because it's the recipient's tax. So that makes sense. So our objectives here are to recognize taxes payable or hopefully refundable for the current year. That's your first objective, and that pretty much depends on the tax department or you if you're the one preparing the tax return. Second, to recognize deferred tax liabilities and or assets for future tax consequences of events that have been recognized in the financial statements or the tax returns. In other words, revenues, expenses, gains, losses included in taxable income in a different year than for financial income. It's interesting. I always like to say that accounting, while it has its flaws, has a logic to it. It's all based on a structure that goes way, way back to Luca Pacioli and his debits and credits, and it's a very logical thought process to come up with income and, of course, a balance sheet and such. But tax laws are a totally different animal because, of course, they're based on managing revenues for various governmental entities. And when you think about that, there's no way they're going to be the same. So you're always going to have differences. In addition to that, we're going to look at events that cause differences between the tax bases of assets and liabilities and their financial bases. And once again, it gets down to differences between how we look at something for financial statement purposes versus how we look at it for a tax return. And we're going to look at operating loss or tax credit carrybacks or carry forward. So those are the things that are going to create these deferred items, which we're going to talk about at length in just a little bit. Now, that second objective, dealing with the future scenario, is constrained due to various factors. First, the payment or refund is the collective result of all items in the return. See, so what we're looking at is something kind of in a void and projecting it forward to a future where there could be all kinds of things going on. The payment or refund is the joint result of prior and future years. And future information, of course, is limited. So the effect on a particular item is somewhat arbitrary, and I'd say tremendously arbitrary, and it requires estimates. And I think we need to establish this right up front. This is not an excuse to do a sloppy job, but the reality of it is your deferred tax asset or liability is at best a stab in the dark. So the goal is to give a fair enough number that we can, and in my opinion, the goal here is to create a concept, to tell the user, hey, by the way, remember there's differences between how we do it on the tax return and how we do it in financial statements. And so because of that, there's this nebulous amount that might be due or refundable in the future. And I really think that's the key message we're trying to say, but of course trying to be as accurate as we can with that estimate as well. Some events do not have tax consequences. Exempt income. Well, that's not going to cause some future event. It just isn't going to happen. Or non-deductible expenses. You go out for a business meal. You can only deduct half of that. That's never going to create a tax scenario. So those don't come into play at all.